Welcome to the Self Storage Show, where I have conversations with my industry friends, talk with owners and vendors, and share tales about my management company, 3 Mile Storage. Let's go. Hey everyone, so I just finished putting together this new book, 3 Mile Storage Management, 3 Zones of Excellence. This is our framework for success in self-storage. Want a free copy? Okay, here's the deal. Book a strategy session with me. Together we're going to walk your business through the 3 Zones of Excellence framework. And I've done countless sessions like these over the years with many self-storage owners. I guarantee you that together, we're going to reveal some ways to increase your leads, rentals, and revenue. So go to 3milestorage.com and book your time today. Hi everyone, it's Jim Ross of the Self Storage Show. Got a good one for you. I got my friend Jane Sauls with me today. We've kind of done a few things over the years. It's nice to have you come back, Jane.
Good morning, and thank you so much for having me, Jim. It's always a pleasure to be here.
Yeah, that's good. It beats having to get on a plane and travel around and give a little presentation. We can just click a button and cool, there we go. We're
Yes,
here.
yes, that's exactly right.
I love it. If you don't mind, just kind of give us just a little background on you and what you do with the Sauls Group, and then we'll get into it.
Absolutely. So I'm Jane Sauls. I'm the co-owner of Sauls Storage Group. I'm business partners with my son, Luke Sauls, and our team consists of Mike Patterson and Veronica Lee and Luke and myself. And we specialize in self-storage investment sales. We work with buyers and sellers, and we had focused in the past basically in the Southeast. And then as of this coming up year, we are branching out, and we've got some strategic partners that will allow us to go into all the states. What we have learned over the past several years, and as we see things changing in our industry, is the consolidation of the actual ownership of properties. And so in doing that, to better serve our customers, clients, we see a need of being sure that we're able to go into whatever market that they're owning in. Because the reality of it with self-storage, Jim, and nothing changes, nothing magical happens when you cross a state line, yep. Right? From a real estate license perspective, a lot may change.
Sure.
But but from the ownership of self-storage, the portfolios that we're seeing being put together, has no boundaries as far as state lines are concerned. And so we're excited to be offering that. And I come from a development and operations originally background, and then my degree is accounting. And so when you roll all of that together, I'm kind of always been that business model junkie. Yeah. And so, in the past have done numerous asset classes of different, from a controller perspective and asset manager. Once I was aware and become familiar with the business model of self-storage, there was just no turning back for me.
Yep.
So, we also own a facility locally, and then manage one that's convenient as well to our office. And so that really gives us the continued hands-on approach and understanding. When we hear what's going on in the market nationwide, we can often either relate to that, or maybe we're a little bit ahead of that or behind that trend.
Well, that's kind of why I wanted to have you come on, because I know you got your finger on the pulse of what's going on, not just with your own operations. Remember back in the day, I had you on that Beat the REIT Summit because we were focusing on your operations with remote stuff, because I love that perspective, because you own, but you're also with the brokers and have that kind of perspective. So again, we're very well versed on what we're talking about here. So that's why I wanted to have you jump on. And again, it's kind of going on what's happening right now. The market's a little bit different. I mean, that's any market. It always changes, but you got to know what's going on with your own operation, what's happening. And I know some people are kind of freaking out a little bit. And we were chatting earlier about just some valuation nuggets that you can kind of focus on to get those things boosted and moving in the right direction. So I know you actually got some slides. Look at you, overachiever. So you can go from there.
Let's see.
Look at that. It's working.
Can you see me okay
Yeah,
there?
you're good. Yeah, perfect.
Perfect. Very good. So yeah, we truly just are here to help people. And I think that in talking about some people are kind of, I'm going to go with freaking out for like your lack of a better way of saying it. I think that depends on a couple of different things. One is, who are you talking to, and what are you listening to? Yeah. And then the other side of that is, what have you done to get to where you are? And if you've made solid business decisions up to this point, you're probably not freaking out. But if you don't understand that real estate is a long game, you may have some anxiety. So we are truly, in what we do in working with owners, it's not that we want to talk to people just at time of sale or when they're thinking about selling. It kind of reminds me of when I was in public accounting and people would come to us on April 10th and give us all their stuff and their tax return done and then be upset at the results, right? And so it's like, no. If you would have come to us in November, we could, we could have helped you with that. Yes, we could have planned ahead. And so this is no different in what we're looking at now. The sooner you come to us, the sooner we start having these conversations, the sooner you understand what your actual goal is and where you're wanting to be and when you need to get there, right? Because you're going to have to run where you want, like we were just talking earlier about what was important to us was being available to our kids when they were a particular age. And then as they move on and grow and don't need us, our needs change as well, or our availability changes. And like for you, you're on the brink of looking probably for college money. So, whereas at one point I had 3 in college at one time, right? And so my personal needs was different then than it is now, or my flexibility maybe. So taking all that into consideration, I always like to just kind of share the greenstreet.com, or it's from greenstreet.com is where you can pull it up. They do a great job, Jim, in just actually kind of keeping their thumb on the pulse of all the asset classes. They're one of my favorites because they actually single out self-storage as its own asset class. Because, as wonderful as we think self-storage is, some folks still don't give us our own line, right? And we get clumped into other. Sometimes we get thrown into industrial. Depending on who it is. Green Street does a great job, I feel like, and I've been tracking with them now for years. But you will see in those first columns under March 2022, that was peak valuations as far as industry and nationwide. And so we had moved up to 69% increase in valuations. And so that is comparing March 2022 with before COVID, which would have probably been more towards that end of year 2019. I don't know if you remember on 2019, all of the brokers was getting asked, what inning are we in? How long is this going to last, right? Because it was really good at that point, right? Because we were in good times and everybody was wanting to know, was we going to see extra innings? So my joke there was, because we was talking about sports as well a little bit earlier, I did not know in 2019 what inning that we were actually in, but I did know, or I felt confident, that self-storage was going to be in the championship game. So
right there. Yep. Let's just look at these numbers. Yeah, if you don't mind, for people that are listening and not watching this, can you just describe a little bit about these percentages that we're looking at?
Oh, yes, absolutely. I'm glad you pointed that out, Jeff. Okay, so in March 2022, all property had increased by 15% from pre-COVID numbers. Self-storage had increased by 69% in March of 2022 compared to from before COVID.
Mm-hmm.
And then we have, of no surprise, office had declined by 4%.
Yep.
And the only item at that point that had a higher index value was the manufactured home. That asset class was at 323 from an index value perspective, and then self-storage is at 312. And so knowing that, just kind of keeping that relative indicators in mind, all property index was at 155. And I know that there's a lot of talk, or, multifamily apartments always get a lot of attention, if you will, or it's kind of a little bit of a classy asset from an investor perspective or proud ownership. And their asset class had went up 23%. But we all knew that, what goes up must come down, I guess. And so when we flip over to now, and this is as of September 2023, and then I think this past month, we've seen very little change to this as well.
Yeah.
All property, and this is comparing today to the peak valuation. And so all property has dropped 16%. And then self-storage has dropped 14%. And so, and just kind of regrouping and summarizing that.
Yeah.
So if we just think all property, and all property is only referring to commercial real estate, it is down 16% from peak valuations. At peak valuations, it went up 15%. And so basically, you're in the hole, if you will, from an entire all property asset class, a percent. Because when you just hear that self-storage has come down 14 and all property is 16, you're like, storage doesn't sound like it's doing that great.
Yeah.
But when you take into consideration, we went up, Jim, 69%. Only to come down 14, right? And so that is tremendous.
Mm-hmm.
Because our index value there is at 269. And once again, only the manufactured home has a stronger index value than we do with that. So I think that those things are important to keep in mind. Also, when you see that office currently is down 31% since March of 2022, 31%. And the reason I even mention that again, Jim, is because conversions and self-storage have, I guess, over the last 10 years, have been a huge part of our industry. Movie theaters, bowling alleys, the Kmarts, the old grocery stores, converting that. And we're already starting to see some of the office product being converted. And so
that's a huge opportunity. Okay.
Yes. And the problem I have seen so far, because I guess I've looked at a dozen or so of those, the problem I've seen so far with the ones I've looked at is many of those products are in markets that already have intense supply of storage.
Okay.
So and the product probably isn't going to be priced in a way that makes storage work as long as it's still owned by the investor. But if that flips and becomes a bank-owned property, it may be an opportunity. So not necessarily for every situation, but just kind of wanting to put that on the radar for folks to kind of take a note of that.
Yeah.
I thought this was also interesting from the perspective of consolidation, because I know when we, talk with folks about what they're doing or not doing and need to be doing to improve the value of their facility, sometimes are not as concerned. They're like, oh, I'm just going to pass it on to my family kind of attitude, which is, hey, that's an awesome opportunity for a lot of people. But you still need to be understanding the way that the competition is moving forward.
Yep.
So the rest of the industry, which is everyone except the public companies and then those 100 top operators, right, went from 52% ownership down to 41% ownership.
Oh, wow.
And so that's, and we've been seeing that now for years. Folks will just buy, that's the business model for many investors, is not just the monthly cash flow, but being able to buy up individual stores, put that group together, and then spin them off to that next tier investor.
Yep. And a 10% difference in 3 years. Yeah, 3 years. Wow. That's that just shows the consolidation with what's happening. You look at stats in black and white. It's crazy.
Yeah. And it's referring back to us originally being on the podcast, or my first time on here was about that unmanned model, right? And then that's what you do so well now. But that's what we're seeing that's made this so attractive to non-local investors, right?
Mm-hmm.
And so anyway, just some fun facts to share this morning to get the day started.
No, what do you got here?
Well, I just wanted to do a quick kind of breakdown on because when we were working with people, sometimes brokers, they see us, our group particularly, it wants to be involved with you more than just at time of sale. Because if the health of the industry maintains its integrity, Jim, we're all going to do well, right? It's when we start getting our projects start getting in trouble, we're all going to hurt from that. Your neighbor's going to hurt, from that. And so from that perspective, I wanted to talk a little bit about interest rates and how I know that people who aren't selling may think, oh, that's not important to me. But if they're going to be refinancing, I just wanted them to have a little bit of content, what that might mean to them moving forward.
Oh, no, that'd be great.
So, please. Yeah, I just did a little quick scenario, and I did it at a 5.5% interest rate with a 20-year AM. So for those not able to see the screen, the purchase assumptions, the purchase price, $5 million, a 70% loan to value with an interest rate of 5.5% on a 20-year AM makes that monthly payment a little over 24 grand. And then the annual payment is around $289,000 a year. Because Jim, all the buzz is in our industry, it seems like, is cap rates and what are cap rates doing, and how do we even calculate cap rates and yada yada yada. And so I wanted to point out that it's not all about cap rates, and as much as you can discuss the cap rate or debate it, if you will, because it's up to the investor of their expectations of what they're willing to accept as returns. So I did some revenue assumptions here on a 40,000 square foot facility, getting $1.10 with a monthly gross potential of 44,000 monthly gross. Yes, the 44,000. And then I've used a 30% expenses. And what we're getting to here is our debt service coverage ratio is the whole point of this demonstration. So that NOI is at 369,000 and your debt at 288,000. So your debt service coverage ratio is 1.279. And why this is important, Jim, is because the folks going back to refinance, those folks probably aren't going to get to see 5.5% right now, depending on what that bank's appetite is. And I think sometimes our memory is short in the sense of folks forget the things that did happen in the last downturn. And it doesn't really matter if the situations are the same that caused it, but when the perspective changes outside of the performance of your facility, because in the last downturn, we had a lot of folks, or some folks, banks, they changed their perspective on what their balance sheet needed to look like. So those decisions wasn't based off of if your facility was ahead of the pro forma. It was purely based off of, I don't need that on my books per the bank. And so a lot of people had to pay their debt down to get that debt service coverage ratio, in line with what the bank was looking for.
Gotcha.
So if you refinance that, and I jumped at 3%, so to 8.5% interest on that refi. And so a lot of people have a floating rate, some fixed, it can be based. So 5.5 to 8.5, that, you may be going, I'm not going to be at 8.5. Well, you may not have been at 5.5 either to start with. So the intent there is to show the 3% increase in interest rates based on whatever it is that your actual mortgage is. So if we don't do anything to our NOI, we don't do anything to maintain our expenses or increase our revenue, Jim, that's going to put our annual debt at $331,000 plus, which puts that debt service coverage ratio at 1.1. Whereas, a few years ago, that was a number the bank they didn't fret that too much. Whereas today, banks are much more conservative and looking towards that 1.2 number.
Gotcha.
So just getting into kind of that deep dive of understanding, regardless of where owners are, whether they're looking to hold their property forever, if they're going to have to refinance, they're going to need to go ahead and start being aggressive and aware, if you will, of how they can make improvements on that NOI. Because again, cap rates, you can debate those on how it impacts your valuation. And if you're going to be, 30% loan to value or 70%, whatever, loan to value, wherever you're at on those numbers based off of that cap rate. But you can't really argue that the debt service coverage ratio is coming off of your NOI. And your NOI is what you are providing. It's what you are solely responsible for.
And so for people that are listening to this, and again, I'm sure we could probably have another 2-hour conversation on just, how can they improve on the NOI? But I'll put you on the spot because I know you can rattle this off the top of your head in 2 seconds. What are kind of like a quick little checklist on what they could be doing for improving their NOI here? I mean, we got to end on a positive note here.
Yes, and there, like you said, there's a ton of things. So the first thing I'm going to say is the simple stuff, as in, if you know better, then do better. Because Jim, we could rattle off the list, but most folks listening to this, they know what they need to be doing, and they need to have the discipline to start doing it, right? And that you need to be running your business today as if you're going to sell it tomorrow, period. None of us are getting out of here alive. And so you really need to be sure that you are leaving your family or your partners, whatever your setup is, with an asset and not a liability. But I think the biggest thing, as our rates are softening, Jim, it goes 2 different ways. Rates are softening. That's common knowledge, nationwide, industry-wide.
Yep.
but those existing customer rate increases, and I think it gets a lot more stressful on the independent owner to increase their existing customer rates as things kind of get tight. But that's going to be so important because every little dollar, if there's any such thing as a little dollar, every dollar is going to make a big difference on those valuations. And so one of the things that they've got to be doing is those existing customer rental increases on a regular basis. So, and when I stress that on a regular basis, I am talking about the process. I'm not talking about what some of our big guys are doing now. I think there's other words for what they're doing actually. So I'm talking about not how often, like if you decide to do it every 9 months for your existing customer, so be it. If you decide 14 months is a good number for you, so be it.
Consistent.
But what I am saying is to consistently every month, somebody is getting a rental increase. And it doesn't even matter to me if it is 5%, 12%, you figure out what that number is and you implement moving forward and doing that every single month.
Yep.
And then the other side to that, and in good times, we absolutely go crazy on the revenue side and focus all on that. And Jim, what we see is normally the expense side kind of goes unwatched, unattended to, get a little sloppy down in those line items. It doesn't seem to matter as much because enough money's coming in. But now as we kind of go into the mode of that whole batten the hatches down just because you don't know what you're going to face this coming up year in the next 2 or 3 years, you need to go ahead and be sure you are being a good steward in every line item, on your expenses.
That's something I don't hear talked about enough, and I definitely don't when it comes to, because I'm all about the revenue. I don't hear very many people talk about look at your expenses. Is there anything that pops out that of a line item of focus?
Absolutely.
Okay.
I have a handful of them now that I think we better be really on top of. And one is not anything that we cared about in the past, and that's credit card fees.
True.
Right? That's been a cost of doing business. That's been a savings to us because we don't have to go to the bank. We don't have to have on-site people. But you're going to see, or at least I think we are, as there's credit card companies are in a tough situation because of all of the fraud that goes on, how much the cards are being compromised. So I think that as things tighten down for them in that perspective, we're going to start seeing increases. You're going to see increases on those fees, and then you're also likely to see a difference in when the money hits your bank. As far as delaying that another 24 to 48 hours. So those little things are going to start making a big difference. And let's face it, the credit card companies, they're smart folks. They know that we as a society depend on that credit card, whether we're buying or, taking the money. We as a just the way that we live, we rely on that. So from a supply and demand perspective, that percentage is going to go up. Property taxes as an asset class, we are absolutely being targeted in numerous states. The National Association has done a great job getting several different states' legislation passed to where we are not being valued from an income approach. It's more of a construction cost replacement approach. And so join your state association, because the legislative advocacy that they are doing on our behalf as owners is going to be a huge deal. I mean, we get excited because many of the states are moving forward, not having to do advertising in newspapers for auctions, right? So that's not as tremendous of a line item as what property taxes is going to become to us. Our local municipalities are going to continue to, I'm going to say, get what they can from who they can, Jim, just because of other businesses in their communities are probably going to start struggling and feeling a hit there. So those are two big ones. Your insurance, be sure you got a self-storage insurance agent that is battling for you on the best product out there, because it does need to be self-storage specific. Yep. But the cost of construction is much different than what you did 10 years ago, right? So the cost of replacement from an insurance perspective, not to mention insurance companies are taking on a whole different battle. It seems like we are not just having the natural disasters, but now we have lots of, I'm going to refer to them as random and extreme fires as well. You know, just kind of more freak things going on. And so, and we always need to be aware of our payroll and how we're handling that. But that should be something that you're seeing that more as an investment, and just making sure from a payroll perspective that you're not trying to cut that number as much as you are in doing your part in bettering the people on your payroll, so that they can become better people and better at what they do, and then they can in turn become more aware of all the line items and the ways to help make you money.
Well,
as
you're talking about this, you're giving me some ideas. I want to start focusing on some specific webinars or strategies or a podcast just about going through a P&L. I want a P&L and just kind of go through that. Like an example, I think I'm very helpful for people of just showing some of these items that you just kind of gloss over, frankly. And we really have a focus on it, have a big impact. So no, thank you for that. You sparked some ideas for me.
Yes, good. I think it's kind of like the way we run our households sometimes.
Yeah.
You know, if you are in kind of a slim year of revenue, maybe your spouse is taking time off to be with kids, whatever your case is. But when that's the case with your house, all of a sudden you're turning lights off, right? You're not eating out for every meal. You're starting to do those wise, more good stewardship things. And then when everybody's working and times are good, you're running through that drive-through. You're, so oftentimes we forget, like, the two worlds are truly the same in the way that we should approach them. And there's no excuse for us not to be a good steward in both places.
Oh, that's fantastic. As we're wrapping up here, so I want to make sure, any more slides?
Oh, let's see here. I think I have.
I don't want to cut you off. Let's see here.
Yeah. Yes. Look, do we have time to look at this scenario of the existing customer rent increases?
Go ahead.
Okay, so in talking about doing it on a consistent basis, I'm going to run through this really quick. Monthly rent roll, $50,000, just a 5% increase, okay? And the whole idea here is showing whether you do it when you get around to it, or you actually do this every single month, the consistency of the process. So if you get that 5% every single month from a 12th of your customers, this assumes that you just increase somebody every 12 months, existing customers, you are going to increase your annual cash flow by almost $14,000. So $14,000 increase in cash flow by getting a little bit each month from your customers. And what that does from a valuation perspective, Jim, I did it at a 7 cap. it increases your value almost $200,000.
That's crazy. I love doing that demonstration when I'm talking with owners just to see that impact on, put a cap rate on it. It's one thing about seeing the monthly increase, but you put a cap rate on it and it really kind of hammers it home.
Yes, yes. And I tell the owners that if they don't think 13 grand is worth, bending over and picking up, just offer it to their people, offer it to their manager. Because I don't know of a storage manager that wouldn't appreciate 14 grand a year.
Yep, of course. Yeah, fantastic.
We are here to help Jim in whichever way that folks, have intentions of moving their property to the next ownership level. So if there's ever any way that we can help, we just, we're kind of geeky and love the whole number side of things. But more importantly, Jim, we truly just love connecting with folks, and it's fun to watch folks' dreams come true and get to be a part of that, whether it takes, a few years or 20 years. It's just good stuff.
Well, that's why I always like to have you on, because you're genuine and you care, and that comes across. And so for people that kind of have that kind of philosophy and that mentality when it comes to their business and helping others, I wanted to get as much exposure as possible. So that's why I'm glad you're on here. We'll do more. But as people are listening and not watching this, how do they reach out to you?
So you can reach out to me on phone or email. So it's 770-328-2379. And then my email is jane@saulstoragegroup.com. I am on Facebook and LinkedIn. So I always welcome folks and encourage folks, you really, before it's even time to consider selling, get to know your broker and what they're about. And so I welcome folks to follow me on Facebook. And then I'm on LinkedIn as well. And of course, our website is saulstoragegroup.com. So you can find all of our information there as well.
Perfect. Well, again, thank you for being so gracious with your time, Jane. We'll do it again.
Thank you.
Take care. Bye.
Bye.
Before we wrap up, just a quick reminder. Do you want to level up your storage game? Visit theselfstorageshow.com. Grab some high-value freebies, check out top vendor spotlights, and stay in the loop with our newsletter. Do you want to chat about becoming a client with 3 Mile Storage Management? All the info's there. Plus, if you've got a story to share, we're listening. Everything you need is at theselfstorageshow.com.